Hello everyone. The month of October was, I think, a sigh of relief from a bond market perspective. For starters, we saw a status quo on interest rates, on the benchmark rates by the Reserve Bank of India, early part of October, specifically on October 5th. That brought in a new lease of life for the bond markets, which were expecting anywhere between 25 to 50 basis of rate hike. So the 10-year benchmark sovereign bond yield, which was hovering at around 8.15 before the policy, closed in at about 8% post the policy, and the October month end has closed in at about 7.83 to 7.85. Similarly, at the short end of the yield curve, specifically on the corporate bond side, we saw some relief, largely, as I said, because the markets had priced in a rate hike, and because it did not fructify, even the short end of the yield curve saw some respite, specifically on the CPs and CDs front. The liquidity in the system, however, continued to remain tight, which got some strong support via the RBI's open market operations. So in the month of October, the Reserve Bank of India conducted open market bond purchases worth 36,000 crores. The good news is that in the light of the negative system liquidity or the banking system liquidity, the Reserve Bank of India has announced an additional 40,000 crores of open market bond purchases for the month of November. This, we believe, will act as a strong catalyst to bond yields, specifically on the sovereign side, which has been reeling under pressure due to foreign portfolio investor sales, which is FPI sales. In the month of October, the negative net sales by foreigners in the bond markets were about 9,000 crores, and in the year to date, which is January year to date, the number now totals around 60,000 crores of negative net sales. This, alongside the fact that the potent sources of demand from the domestic institutions like banks and mutual funds, maybe selectively insurance companies are buying, but the other two sections are largely conspicuous by their absence. I think that had led to some sort of a lack of demand, but the open market operations, as I mentioned, has acted as a strong catalyst in supporting the yields. How do we think things could move going forward? So having ascertained that there is reasonable certainty of someone absorbing the supply of government bonds via open market purchases, I think November also could largely be range bound. Probably the current levels, we could see another 5-10 basis points of easing, but on the upside, the yields could remain capped for now. Additionally, crude oil prices have shown a decelerating trend by almost $10 in the month of October. From a peak of about $86 a barrel, we are trading at around $76 a barrel. And the dollar rupee, which is another key factor to wait and watch, also seems to be stable at the current juncture. In the coming weeks, in the coming months, I think a lot is going to be critical from a bond market credit standpoint, as we have maturities lined up like we had in the month of October. But let me also reassess, clarify our stance that at this juncture, there seems to be more noise than news in the market, more rumor than reality, more cacophony and less of harmony. What I'm trying to say is that in such kind of markets, there are a lot of rumors which are floating around with respect to any and every NBFC and or HFC or housing finance company. I think it is prudent in such times not to really base investment decisions based on such kahi suni baatein. it's very critical that if you have an investment outlook within a particular fixed income category, it is very important to stay the course and do certain amendments to asset allocation depending on what one had originally envisaged. It is situations and it is circumstances that like these which offer entry opportunities if one were to rightly ascertain which category within fixed income one wants to make allocations, and more importantly, what is the intended tenure of such horizons. So on that note, wish you all a very, very happy Diwali, prosperous and a safe one, and definitely a very happy investing. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.